All right, without further ado, we have CommonBond here, which is a student lending platform. Crownetic, if you are around, please come to the tech booth and get your presentation set up. But let's welcome CommonBond.
Thank you. Hi, everybody. My name is David Klein, co-founder and CEO of CommonBond. CommonBond is a student lending platform that is committed to making the student lending experience better. We do that through a few different ways. One, through appropriately priced financing for borrowers. Two, through superior customer treatment. And three, through something we call our commitment to community. Couple quick hit stats on us. We expect to do about $100 million in originations by the end of this year. We expect to have in our community of borrowers over 1,000. Who are our borrowers? When we launched last year and expanded nationally, we focused primarily on MBA graduates. We have recently expanded to law graduates, medical school, and engineers as well. We would expect for methodical growth to continue throughout 2014 and 15. Who are we? This is the management team here. I just gave you an intro to myself, a background in consumer finance at American Express, McKinsey before that, advising mostly financial services clients. My co-founder and company CFO, Mike Taramina, was at JP Morgan for about 6 to 7 years underneath the chief investment officer at the private bank. John Burge is our chief risk officer, spent 15 years as an underwriter at American Express on both the consumer card side as well as the small business side as basically the head underwriter over there. And then Rob Granado is our head of operations. He used to be CEO of a commercial lending platform in New York. He's an MBA himself from Columbia and a former captain in the US Air Force. Who are our investors and backers? We're fortunate to call among our key backers Tribeca Venture Partners, a venture firm based in New York, as well as Social Plus Capital based out here in the Bay Area. In addition, we have some individual investors, Vikram Pandit, former CEO of Citigroup, Tom Glosser, who used to run Thomson Reuters, now sits on the board of Morgan Stanley, and then Tom Kolaris, who used to run private wealth over at Barclays. So that's a quick hit on us, who we are, who we're focused on, where we look to go, who's on the team. If I take a step back and talk a little bit about the problem that we're looking to solve. On your left side is essentially how big the newly student loan origination market is every year. It's over $100 billion. To your right is what the outstanding amount of student loans is in the country today. It's over $1 trillion. It surpassed credit cards in 2012. It's the single largest source of unsecured debt in this country, and as I'm sure many of you have read the headlines, it's a pretty big problem to solve. So what we've done is we've started to focus on a subset of the $1 trillion market. The subset that we're focused on first is the subset that we believe has a very strong ability to repay. The way we size that market very conservatively is about $60 billion. I think you'll get others to size our market in the neighborhood of $100 billion. Needless to say, it's a large market. There is a major problem in that the federal government and the private banks, as the incumbents in the space, have been charging rates that are too high and putting borrowers through a process that is unnecessarily overwhelming and complex. And so what we've done, my co-founder Mike and I, when we ourselves were in business school at Wharton, where we met, we went through the process ourselves, having to pay our way 100% with student loans. We realized the price was unnecessarily high. We realized the process was unnecessarily complex. So we decided to take our backgrounds in finance and do something about it. This is a little bit about, from the consumer's perspective, how CommonBond fares. We currently have a refinance product as well as an in-school product. Refinance is about 80% of our portfolio, in-school the other 20%. If you just blow out the refinance for a second, and you take a look at what many of our borrowers for the past, let's call it year, have been refinancing out of, it's been federal government and private bank debt, which has been priced in the neighborhood of 7 to 8% APR all in, compared to, say, the 10-year rate at CommonBond, 5.99%. Our borrowers can save upwards of $17,000 over the life of the loan. So pretty significant economic value proposition. There's a second piece of it too, and that has to do with the community that we're building. What does community at CommonBond look like? We host community events, both online and offline. Why do we do this? We do this because we believe that in addition to lowering the personal expense line of our borrowers, we believe in maximizing the personal top line. And the way that's done is through facilitating meaningful connections. And so we've developed this great community of students and grads and alumni and accomplished professionals all around the country who help each other get jobs with career advice. We have one MBA I'm thinking of who was introduced to a reporter at Business Week through our community. 2 months later, Business Week covered her startup that she was trying to get off the ground, and 2 months after that, she raised her first $1.4 million in seed funding. And so what we're seeing as time goes on is that there's true value in this community, many times much more than $17,000 over the 10 years of repayment. Results to date have been, I would consider, strong. Our typical borrower is on your left. They're 31 years old. They have over $120,000 in income. The FICO on average is 750, and they're taking out on average about $75,000 in debt with us. If you look to the other side of the screen, so far we've experienced 0% net loss, default, even 0% delinquency. And so what we found is that the thesis has really begun to play out. Now, we would expect loss to land at about 1% cumulative net over time. We are exceeding that expectation a little bit right now just because most of your defaults and losses happen in the first 2 to 3 years in student loans. And we launched our first loan program at the end of 2012. This is our timeline. 2012 was all about launching at our beta program at Wharton, which is where we all met as co-founders. In 2013, it was all about expansion. That's when we brought a little over 100 million onto our platform. We expanded to 25 MBA programs and gave us a lot of momentum heading into 2014. 2014 is all about reaching scale. So we're now in over 100 programs across those 4 degree programs I was telling you about before: MBA, law, medical, and engineering. And then in 2015, we consider this scale plus. This is when the hockey stick really starts to happen and we start expanding beyond just 4 degree programs. We've been fortunate so far in that our platform and this space in general has been gaining a lot of traction with borrowers, a lot of traction with investors, as well as a lot of traction in the broader market, from The Economist to Forbes to the New York Times. That's pretty much where the presentation ends. I would love to take your questions. The slide I have up here, before I do, just to give you a sense of what you're looking at, these are 9 of our initial borrowers. They were part of our beta class at Wharton at the end of 2012. And what I love about this photo, and we have it framed in our office above our office fireplace mantle, to connote the CommonBond family that we're looking to really build over time. What I like about this is that we're not just a financial platform, a student lending platform, but what we really are, and we mean this in a lot of different ways, is a community. And you'll probably hear community talked about more and more throughout the day. I know on the student loan panel at 1:30, it's something that we'll be talking about. And what's important to me here is that when you talk about community with a group generally whose investment focus, capital focus, platform focus, community can sound very soft. But what we've done, A, and how we've built it, and B, what we've seen in terms of what community can do as a way to manage risk on an ongoing basis in an intelligent and thoughtful way, I would expect community to be a larger and larger part of what a number of us emerging platforms coming to this space will start to talk about and take seriously. So with that, I think there are 2 minutes left. Take questions. Yeah. Right. So the question is, what happens when you go down the credit spectrum? Don't you have to change your model? And the fact is, if we decided to go down the credit spectrum, sure, we'd have to start risk-based pricing in a different way and price appropriate to the risk that we're undertaking based on how we're underwriting. And so that's a possibility. What's also a possibility, and certainly our strategy, is that we're looking to stay with a specific group of high credit quality borrowers over their life cycle, as opposed to staying within one particular asset class over time and getting growth through going down the narrow T. We're looking at growth going across the broad part of the T. And so from our perspective, our ultimate vision is to become a financial services firm of the future. So student loans is not where we start. Rather, it's not where we stop. It is, though, where we start. We're getting these folks at 31 years old. If we can get that interaction right and develop the trust necessary, we believe we've earned the right to provide other financial products and services to them over the customer lifecycle. Yeah.
What is the investment thesis for the investors that you're getting in?
Yep. So the question twofold. One, what's the proposition to the investor? Two, what's the profile of the investor? The proposition to the investor, if they want to take on a loss-adjusted 5% unlevered return, they can do that on the CommonBond platform. What makes this investment different than a lot of other investments out there, particularly in the peer-to-peer space, is the underlying risk. So the numbers that I put up before around 0%, not just loss and default, but delinquency, are expected 1% loss over time. There are investors out there who appreciate the balance and efficiency of the risk-return trade-off. And so at 5%, again, risk-adjusted, loss-adjusted, on an unlevered basis, we're finding investors find very strong, number one. Number two, and this goes into the profile of the investor question a little bit, we have, as you can imagine, institutional and individual investors on our platform. And right now, I'd say, like the rest of the industry, most of the capital on our platform comes from institutional investors. And so when you have an institutional investor who likes the underlying credit quality of this asset, and particularly what our platform is generating, they can add leverage on their end to that 5% return and get double-digit returns relatively easily on risk that's pretty slim.
Thanks so much. Let's hear it again for CommonBond.